The Federal Reserve is currently in a rate cut cycle with the Fed fund rate at 4.25 to 4.5%. It has maintained this range since January of 2025, holding steady for 4 consecutive FOMC meetings. However, this may soon change. Regarding the prolonged pause, Chairman Jerome Powell has indicated that the Fed might have begun cutting rates again instead of holding for that long, but rising inflation expectation driven by Donald Trump's proposed tariff has held it back. Meanwhile, Trump has pressured Powell to resign, accusing him of acting too late or too slowly, just like what he did during the early pandemic period. Back then, the Federal Reserve delayed rate hike due to the belief that inflation back then was transitory, which later proved incorrect as the inflation persisted for many years. However, all those headlines are noises. What really matters to the investors is the market's expectation for future Fed funds rate moves. The market currently anticipates the first rate cut or the first rate cut after the pause is going to happen 2 meetings from today. Right? It's going to be the September FOMC meeting with a probability of 66.2%. And overall, for the year 2025, the market is expecting 2 25 basis point cuts. And for the year of 2026, market is expecting 3 25 basis point cuts. This suggests that while the Fed is currently on pause, the rate cut cycle is expected to resume very soon. So on the balance sheet front, the Federal Reserve remains in a QT cycle or quantitative tightening cycle, which began in June of 2022, just 3 years ago. So for the past 3 years, it caused over $2 trillion to be shed from the balance sheet. And we're currently at the level last seen in April of 2020 with no structural issues so far, aside from the 2023 regional bank hiccups involving Silicon Valley Bank bankruptcy and Signature Bank bankruptcy, of course, but nothing structural. So since the start of the rate cut cycle, the Fed has twice reduced the pace of QT. So originally, the speed of QT was $95 billion per month. So after the 2 speed reductions, it's currently at a speed of $40 billion per month. The market performance and investors' behavior are heavily influenced by expectations around the Fed funds rate and future monetary policies. Hence the saying, don't fight the Fed. A textbook example occurred recently in the year 2022 when Fed launched its most aggressive tightening cycle in decades to combat inflation. And this is a chart of S&P 500 from the year 2022 to 2023. The market entered a clear downtrend in 2022 and repeatedly making lower lows. So the usual strategy of so-called buying the dip lost effectiveness in 2022. This is largely due to Federal Reserve's hawkish stance on monetary policy. And during the 2022 period, investors become less willing to buy the dips, not just because the sentiment is being affected by the Fed, but also because of some technical, logical, and financial reasons. For example, number one is there is a higher borrowing cost when the interest rates are rising, right? The rising yield will make margin debt more expensive. A lot of people on Wall Street, they're borrowing money to get leveraged to invest into the market. When it's harder to get leverage, it's harder to get funding to invest. Number two is the risk-free return becomes higher. When the Fed funds rates are increased, the treasury yields goes up. Those are risk-free assets, and they're able to give you more money, which means in order for the stock market to be just as attractive, it needs to be more rewarding. But during the rate hike cycle, it's hard for the market to be more rewarding because it's going to cause corporate to have lower earnings because for the companies, it's also harder to get access to capital. And another reason is valuation pressure. At rate hiking cycle, the discount rate used in valuing future cash flow increases for discounted cash flow analysis, reducing the present value of a company's future cash flow because your discount rate is going up, which means the companies today are valued less. So all these factors combined reduces investors' appetite and make equity less and less attractive during those periods, right? In 2022, it keep on making lower lows, right? So it's kind of easy for market participants to give up because of how painful this market was, right? So during those hawkish rate hike cycles, investors need to be careful about buying the dip. But the good news is we are currently in a rate cut cycle with interest rate expected to trend lower over the next 3 to 6 months. And that's what stock market is all about. Because the market is trading based on the expectation for what's going to happen in the next 3 to 6 months. Right? So I think because the next 3 to 6 months, the rate cut cycle will continue, this is likely going to have the opposite effect of tightening cycle, the effects I just mentioned, boosting market performance, improving investor confidence. So looking ahead, we can expect a stronger risk-on sentiment among the participants, and the investor will be a lot more willing to risk it and buy the dip. This helps explain the V-shaped recovery following the massive sell-off triggered by Trump's Liberation Day, and also following the announcement of the trade war with China, where the two countries were decoupling with tariff above 100%, and that's over a year, right? Like beginning of April, where $5 trillion were wiped from the U.S. stock market in 2 trading days, right? But then following that, this V-shaped recovery is one of the best, one of the fastest recovery in the history. Well, one of the key reasons for this to happen is having a supportive monetary policy environment, even though it's being held, right? The rates are being held steady, but the expectation is what's important, and it's expected to continue this rate cutting cycle. And the market is getting very confident about it. So looking ahead, I think there will always be shocks to the future U.S. stock market, especially when we have a U.S. president who is pretty unpredictable. But it's very important to keep the current monetary backdrop in mind. We are in a dip buying friendly environment with rate cuts in motion. Right? Investor tends to be braver. That's why I think it's wise to have a dip buying game plan for the future. And it's important to avoid panic selling due to volatilities. So if you follow my channel for a while, you know my preferred approach, which is during all-time highs. When the market is making all-time highs, it's not the time to buy. It's the time to evaluate your portfolio to see if your equity percentage is getting too large in comparison to your cash and cash equivalent. If it is getting too large, it's time to trim, right? And also, when dip occurs, when people are scared, when VIX spikes up, that's when I believe it's a more comfortable and more strategic time to buy. Just remember, the deeper the dip, the safer the investment becomes. Thank you very much.